Today's video is going to be a juicy one because the topic of negative gearing is loved by investors but hated by those who are unable to reap its benefits. Sit back and get ready to learn how wealthy people reduce their tax by paying off the appreciating asset known as property. Welcome back to my channel. My name is Reese, and in today's video, I am going to explain how negative gearing and positive gearing both work, how people use it to build their wealth, and why it's a conflicting topic. In Australia, negative gearing is used as a very tax efficient strategy. The way our taxes are structured allow us to cross income streams. This means that our personal tax deductions and other income losses are able to be offset against our other types of income. An example would be how I earn money from my 9-to-5 job, and I would be able to offset the tax that I would have to pay on that income with eligible deductions from my investment property. So let's go through what negative gearing is and positive gearing is and how they both work. Gearing is a pretty basic term used in regard to property. It's where you borrow money to invest, where the income you earn from rent is either going to be positively or negatively geared. A property is negatively geared when the rental income, so the rent that they bring in, is less than the mortgage repayments, being the principal and interest component of a mortgage repayment, plus any other expenses that come along with the house. And I'll go into a few examples of them in a minute. That is when a property is negatively geared. And a property is positively geared when the opposite happens, where the rent that is coming in pays for both the mortgage and any of the expenses that have to be slapped onto that property during that financial year. And some of the more common expenses you might see with a rental property include things like maintenance costs, council rates, water rates, and the emergency services levy, which I have made videos on some of these topics, and I've left links in the description down below to them. So if you are interested in learning more about them, feel free to check those videos out after this one. And while you're down there, please do me a massive favor and hit that like and subscribe button. It definitely helps the channel grow. So for negative gearing, let's go through a very simple scenario. Let's just say I have a mortgage and there are no additional costs for that financial year. Let's say my weekly mortgage repayments to the bank is $500, and let's say that I get $400 in rent per week. That would mean my house is negatively geared at $100 per week. Whereas a positively geared scenario, also keeping in mind that we're keeping it simple, would be, let's say, where my mortgage repayments are $250 a week and I earn $500 from rent. In this scenario, I would be positively geared $250 every single week. The main reason why investors like the concept of negative gearing or having access to this pretty handy tool is because they can claim a tax deduction on both the interest component. They can't claim the principal, but they can claim the interest that they must pay the bank, plus any additional costs against their income. So this means that when a property is negatively geared, every dollar that goes into it, except for the principal component of the mortgage repayments, literally let them offset that much money from their taxable income and other income sources. So when a property is negatively geared, it is beneficial to that investor because they are able to reduce their taxable income whilst also paying off an asset, being the principal component of the mortgage is paying down the asset that's paying down the loan, and all the other related expenses are just reducing their taxable income. It's a win-win, even though it's kind of a win-loss because they're still paying those fees for that property. That kind of sucks, but at least they're getting something for basically investing their money. And then when a property is positively geared, they are still benefiting. It just means they're making more money than what it costs to run that property. And that's beneficial because yes, they might have to pay tax on the extra income they earn, but theoretically, who cares? They're making money without having to actually do anything. The property is paying for itself, plus providing you with a passive source of income. And this is where I break down a bit because it is actually insane how this concept works. Really picture this for a moment. I am a random dude who bought an investment property. I charge people money in the form of rent to live in that house. Every dollar that they pay me goes back into that mortgage, reducing the total amount of money I owe to the bank, essentially paying off my mortgage for me. If my house is positively geared, it means that someone else is paying off my mortgage for me, meaning I'm passively paying down a mortgage without contributing a single dollar towards it of my own money, of my own income sources. They are paying it down for me whilst that asset is appreciating in value. How backwards is that? It just does not make sense. And if my property is negatively geared, I am claiming a tax deduction for the majority of those payments, reducing my taxable income and not having to pay as much tax essentially, while still paying down an asset that is appreciating in value. For anyone who does have an investment property that doesn't know this, I highly recommend checking out the ATO's website for what things can be deducted against an investment property. You might be surprised, you might not be aware of everything. Definitely check out the link I've left in the description below to make sure you understand what you can deduct, because it's there to be used at the moment while this law exists. Abuse it essentially. I don't see why people don't. I think most people do. For those who are trying to learn about investing in property, this is one of the most beneficial reasons why people get into investing into property. Ultimately, people use this as a small part of the larger strategy towards building an investment portfolio here within Australia. And although house prices seem to be growing ever so high, it is still a very popular method that people use to build their portfolios. Now, like I mentioned at the start of the video, negative gearing is a very conflicting topic here in Australia, especially in politics, because it incentivizes investors to hoard property. And it has been suggested that negative gearing in Australia provides a greater benefit to wealthier Australians versus the less wealthy. I personally do agree that it provides an unfair advantage to those who are fortunate enough to have access to it, which ultimately adds another level of difficulty for those who are trying to buy a home to live in. If you are in Australia and are someone who is intending to own an investment property, understanding how both positive and negative gearing works is only going to be in your best interest. So I hope I provided some value to you in today's video. It will allow you to reduce your tax significantly, especially in the earlier years of the purchase, as your interest repayment component will probably be higher than it will 20 years down the track. Overall, I hope that you enjoyed today's video. I hope you got some value out of it. Like I said, if you did, please hit that like and subscribe button down below. It really does help the channel grow, and I really do appreciate the support. With that being said, I hope you have a good day, have a good week, and as always, I will see you in the next video. Bye for now.